Today, folks, it takes just one bear market for all the bears to come shining, baby. They take their veils off. They show you who they really are.
Many analysts and brokerage houses have come out lately and said that the next 10 years in the stock market returns will not be as good as the last 10 years. And guys, after looking at a lot of data, I could not agree more.
I couldn't agree more. It's all going to come raining down. The sky is falling because I know something and you don't. I looked at the data, and the data tells me everything about the future. Past performance represents everything about tomorrow. And honestly, for as long as I've been investing, I've been hearing shit like this going all the way back to like 2014. I mean, every year there's always a bear out there, and I get it. The price to earnings multiples aren't exactly cheap in the market right now because we're pulling forward so much growth potential that's out there. And we're not saying that growth potential can't come into play, but if you believe in efficient market theory, you know, we're going to go through some ebb and flows based on the data changing. But guys, I don't know what to tell you. These earnings reports weren't terrible by any metric. Companies are doing massive amounts of share buybacks, and I still have a bet on right now that it's not going to be tech companies that really lead the new wave of market performance in the coming months. Now, it could, absolutely, but I'm saying this because the interest rate sensitive stocks I still think are in recovery mode and actually haven't seen the effects of any material drop in interest rates yet. We're still in the middle of cutting interest rates, right? So even if we look at the performance of some of the big tech companies, putting aside NVIDIA, some of the outlying chip companies, I mean, really Meta was one of the only outliers with the exception of maybe Amazon that have actually outperformed the S&P 500 this year because Apple's barely keeping up, Microsoft's hardly kept up, Alphabet's hardly kept up. You could have threw a dart at the tech board and actually underperformed the market this year, which is highly unusual for these magnificent tech companies. And if we just zoom out and we actually just take a look at some of the cross-board performance here. I mean, yeah, it's incredible that NVIDIA's up 175% year to date to Meta for sure. But, you know, when you take a look at the year to date, how is Microsoft only up like 10%? But then you look at consumer defense. You got Walmart here. It's absolutely crushing it. Costco. Some of the financials, Berkshire's up a lot. You know, JP Morgan's up a crap ton. Utilities are absolutely crushing it. Some utilities here that are absolutely outpacing the market. It seems to be in every sector. There's a handful of companies that are really crushing, really helping drive some of those returns. But if you are on a path to financial independence, if you damn well want to retire early one day, join me on that journey as a cost average passive income investor by slapping that subscribe button and liking videos. If you enjoy kind of me breaking down earnings and giving my perspective as we review my 300 and just under 40K odd portfolio. I think we're at what, 336 with the massive pullback we saw in the market yesterday, a little bit of recovery today, but I've been taking profit, no, not out of my tax advantage accounts, more or less my corporate account where I saw more gains than I was expecting at this time of the year. And I want to use the, you know, the Canadian dollar that's been crashing against all my US investments to actually pull some of that US dollar, you know, return out and pay down our mortgage and also take some of that capital to top up our tax advantaged accounts because my fiance has some room. She's in a lower tax bracket. It makes sense to pay her a bit of cash and leave some cash on the side for the end of the year that I can pull out to, you know, again, contribute to my RSP when tax season comes around to put more in my TFSA as well. Once the year turns over, my tax bracket lowers just a little bit here, but we can see that I've still got a nice even spread, 50% S&P 500, 28% SCHD, and about 13% VDY. That's going to adjust once I start getting rid of some of this cash. I'm only almost 10% cash at this point, but again, it's very nominal movements in the portfolio, but you got to just, sometimes when your stocks are just flying, baby, and you got some opportunity to move them around, I mean, why not take advantage of it while we can in the midst of what is an insanely volatile earnings season for how good earnings have been. And here's the common denominator around earnings that I've been personally hearing, which is basically a lot of beats, stocks going down on beats. I mean, there's tons of examples of this. Microsoft beat analyst expectations by 6%, stocks down like 5%, absolutely just tanked on the back of, again, what one would call phenomenal earnings if you didn't look at analyst expectations or if you didn't look at any, you know, analyst reports. I mean, look at Uber here. Uber beat by 125%, absolutely crushed this quarter, stocks down 5.8%. Again, if you just looked at the numbers, forget listening to analysts, forget looking at stock prices, you'd be like, wow, this is one of the greatest earnings. Why is the stock down? That should make you excited, right? Look at Meta. Meta beat by 14%. I mean, they increased, I think their earnings per share by like 30% or something crazy. Stocks down. Does it make any damn sense for a company trading at a 27 PE? If we keep getting 30% earnings per share growth, even on the back of this infrastructure spend and all this stuff, I mean, God, guys, come on. These companies are investing in the future. They have huge growth potential, and they're still growing today at massive clips. Apple is the one that I really want to talk about because they beat expectations, and their stock is down as well. If we just take a deep look into Apple, because I think it's actually one of these interest rate sensitive stocks, but it's way too expensive for the growth that we're currently getting. Because if you look at the 12-month, the ending period here, we've had hardly any growth. not even $10 billion in growth on net sales. The revenue growth is actually like non-existent for Apple right now. And even if you go look and you scroll down and you look at the net sales by categories, things get really interesting here as well. Again, iPhones have barely grown, Macs have barely grown. I think most of these segments like iPads haven't grown, wearables, so even with the new watch release hasn't grown. Services are the only thing that's really growing, as we're seeing that with most businesses today. Just look at like Microsoft Azure, their cloud is growing insanely. Amazon's cloud's doing very well. Everyone is really growing. Google's cloud, like that's where all the real growth potential is coming from, not in actual products right now, because things are just expensive for most people, right? Especially when financing costs are going up and all that stuff. But what really propels the market, in my opinion, continues to be these off stocks. Not a lot of people have cared about, and I personally don't have any affection toward, especially things like Altria Group. I'm not a big fan. I prefer Philip Morris or British American, but you got to recognize when these stocks start to perform, it's kind of wild on the backdrop of tech underperforming. I mean, we only got a beat by 2% from Altria Group. The revenue growth isn't really that crazy, but this is that resemblance of what I keep telling you guys. These companies have a lot of free cash flow. They haven't been able to make like really solid investments with that cash flow, as we've seen with Altria Group and the Jewel, Kronos, and some of these other MJ investments. But when you take a look at their earnings. Their earnings have been absolutely abysmal, and yet people love this stock. And the revenue has been absolutely abysmal, and people love this stock. They're like, what a great business to be in, tobacco in America. And meanwhile, it's growing in other countries way more resiliently, especially with some of the oral pouches coming out of Philip Morris. And again, British American, they just look so much cleaner and better than MO that is purely like US focused. But again, if you go look at the earnings per share, you'd be like, oh, wow, earnings are going up. That's incredible. How are earnings going up so dramatically on the backdrop of horrible revenue? Well, look at the shares outstanding. These companies went on like absolute tangents when they realized, hey, this is a tough market. Why don't we just buy back a crap ton of share? Because it's the only way we're going to boost our earnings. We're seeing that at like Johnson & Johnson. I keep telling you guys this. It's like, companies have so much money today, they can just manipulate their books. They have so much capital. It's like Halloween. These maniacal companies are like, what do we do when we can't grow? We'll grow our earnings because no one's going to look at when they see these big beats, they're not going to look at revenue as much, right? I guess. But I don't know. This is what's really going on across the board here. And again, when I look at e-commerce and Amazon, this one's a bit of an outlier, but it's incredible to see. And I've stated this, that the e-commerce growth rate is traditional brick and mortar continues to die. We haven't seen the extent of the growth rate with things like Amazon yet either. So Amazon's like one of the outliers that did very well this quarter. But yeah, what a slew of earnings. But like I said, I want you to just keep telling yourself that we're still seeing a lot of beats across the board and a lot of stocks correcting, which is going to give us a healthier market environment. I don't believe we're going to get 3% returns over the next 10 years. I heard that. I continue to hear that throughout my entire investing career. Yes, is anything possible? Yes, the market could drop substantially. We could get a black swan event at any time. But if you have a diversified portfolio amongst global stocks, I have a hard time believing, with a healthy dividend yield and some income on the back of your portfolio that you're going to, I'm going to get almost a 3% return just from the dividend. So the market, if it goes up even 3%, hey, we're getting a 6% return. But we'll see. Time will tell, but I'll pass that question off to you. I'd love to know, are you bearish? Are you bullish? Did you have a good Halloween? Let me know in the comment section below.